right, welcome everyone to today's webinar where we're going to have a look at the 2020 federal budget, which was handed down last week, last Tuesday, this time last week. In the last few years, the budget is normally handed down in May, but due to COVID, it was deferred through until October this year, which means at this stage that there will be another budget plan to be presented in May of next year, so before the end of the financial year. So I guess when it comes to this year's budget, the inner accountant in me was a little bit excited about what was going to happen last Tuesday night. Obviously, a lot's happened in the last year, and I was really interested to see what some of these measures would be announced, or what measures would be announced in the budget, and how they might impact particularly our clients and small and medium businesses. I guess I personally left feeling a little bit underwhelmed. I think the government have done a good job of selling the budget, but as we've sort of run through today, the measures are quite targeted, those that are new, and some of the other measures that have been announced that have been old announcements that have been brought forward. So we're going to have a look today at how these budget measures are going to impact small and medium businesses particularly. And I'm joined by my fellow directors today, Garry Pinch, Angela Hales and Nick Fitzgerald, who will all be giving their views on the changes, and hopefully we'll delve into a few little strategies that we might be able to start to consider for clients to take advantage of the benefits on offer. So as we normally start, we'll sort of make sure that we're going to be talking in general terms today. So just keep that in mind, that every client's business is different, circumstances are different. So I think it is going to be important that you do seek specific advice in relation to the budget and how it will impact you. As I said before, the measures are quite targeted, and although the budget has been, I guess, sold well by the government, it will impact each individual business quite differently. So with that in mind, we'll get started, and the first slide is, I guess, just a little bit of a summary around the budget forecast. So part of the budgeting process is to forecast into the future as to what the economy is expected to look like. I guess the main thing here is that these forecasts are underpinning a vaccine being available towards the end of next year. So it's important to understand that. There's been a lot of commentary around as to whether or not that's appropriate or not. We certainly hope that we might get a vaccine sooner than that. But in forecasting these numbers, Treasury have factored in a vaccine becoming available towards the end of next year. So in brief terms, GDP is predicted to contract by 1.5% during the current financial year, but then to grow to 4.75% for the following financial year. So a lot of these forecasts are underpinned on a contraction of growth in the current financial year, but a reasonably strong bounce back in the years after that. And that's reflected in the slide, in the points below, where the deficit is estimated to be $213 billion in the current financial year, dropping to a mere $112 billion the year after, and gradually decreasing until the 2024 financial year, where they're anticipating the budget's predicted to go back into surplus again. Again, as to that, whether that plays out or not, is largely dependent on the timing of a vaccine, I guess. In line with those figures, unemployment is expected to peak in December of this year at 8%, and then gradually reduce after that. So again, that's underpinning the forecasting modelling that things are predicted to get better from the 2022 financial year onwards. CPI is expected to increase during this financial year to 1.75%, which is actually the highest that it's been for a while. Actually got to a point where it was negative 0.3% during the 2019-20 financial year, the period of effectively deflation. So they're a couple of the main, modelling forecasts that Treasury have come up with in sort of setting a roadmap as to where the economy's headed. The government response to all of that, which has been announced in the budget and certainly received a lot of media coverage over the last week, is to lower taxes. And Angela will focus a little bit on the lowering of taxes and encouraging the business expenditure, and that's through the instant asset write-off measures, and then also focusing on job creation through a couple of ways: additional money for infrastructure, but also support packages for manufacturing and skills sectors, and as well as the government's new JobMaker scheme, and Nick will elaborate on the JobMaker scheme a little bit later as well. So I guess, as I pointed out, that there's a few different areas that we were going to cover off on today. We're going to talk about the personal tax cuts and the instant asset write-off. They're probably the two big ticket items that have received a lot of media coverage over the last week. In addition to that, for businesses, there's the small business loss carryback, which is a reincarnation of a measure that was last available. I think it was in the 2012 financial year from memory. There's also some changes to the R&D framework, and Garry will expand a little bit on that as we go through. Some expanded small business tax concessions, some minor tweaks to super, and I'll talk a little bit about that further on. And then, as I mentioned, we've got the JobMaker and the scheme for apprenticeships, which Nick will discuss as we go along. So we will start off with the accelerated personal tax cuts, and I'll bring Angela in here just to give a bit of a brief overview of what this actually means, but more importantly, how it's going to be implemented.
Sure. So these are what we refer to as the stage 2 tax cuts. They were already planned, but they've been brought forward by 2 years. So intended to come in 1st of July 22 and are coming in now backdated to 1st of July 2020. The main changes is that the 19% tax bracket is changing from 37,000 to 45, and the 32.5% brackets increasing from 90,000 at the top threshold up to 120. A combination of that with the next point, which is the low income tax offset and also the low and middle income tax offset, means basically that the taxpayers are actually going to have additional money in their pockets in the 2021 financial year, and as early as probably next week. So whilst the tax cuts are backdated to 1st of July, the government has decided to change the withholding tax tables, which will be incorporated into the accounting software through Xero and QuickBooks Online and MyOb and the like, so that employers can correctly tax wages as of probably by the end of the week is their prediction. There was some talk whether or not they would factor in those tax cuts to actually take into account the reduced tax of the last quarter, July to September, but they've decided not to do that. Wages will be taxed correctly at the lower rate from the end of the week. We'll be able to by the end of the week with the new rates, and they're leaving the additional amount that you might be able to get to your 21 tax return. So generally, if you're entitled to those tax cuts, that you should see that as a refund in your 21 tax return. And the other thing that people can do is for those taxpayers that might have a quarterly tax instalment for July to September 2020, is that they're encouraging them to look at whether or not that's actually going to be payable, because or be able to essentially be reduced, because you actually are due some tax cuts for that first quarter. So more than fine for you to get the benefit by reducing them, or wait for your tax return to actually get the catch up. It's actually, for anybody like up to say 45, or if under $40,000, the actual savings is about $1,080. And it increases up to over $2,500 if you're earning around 90, to the max of about $2,745 for a single taxpayer, or up to $5,490 for a dual income family. So nothing to be sneezed at. That'll help people in these times.
Yeah, I guess just on that, someone earning $40,000 is going to get roughly $1,000 tax saving, which actually represents 21% of the tax that they pay. So they're effectively getting a 21% tax cut for someone that's earning $40,000, which is reasonably significant. And as you mentioned, for someone earning sort of up to $100,000, they're going to get about a $2,500 tax cut, which represents about 9.2%. So, I guess in isolation, they don't seem like big numbers, but then when you add them together for a family, it becomes more attractive. And then when you add them together for the whole economy, it means there's going to be a lot more money floating around. And that's the concept, is that the government want additional money in the economy to stimulate growth. And this is one of the ways of doing it.
So there's still stage 3 tax cuts that were still planned from a couple of years ago that are still on track to come in as of the 1st of July 24. They're called stage 3. They're still planned, and that they're going to even be much more significant savings and simplifying the marginal tax brackets for personal income tax.
Yeah. And I guess the opportunity that presents itself there for clients is the potential to defer income through to the 2021 financial year, where we've effectively got lower tax rates. So there's a number of ways that we can do that through prepaying of expenses and particularly accounting treatments, where we might look at getting income that we might have otherwise considered paying tax on in this year, somehow getting it into the following financial year where the tax rates are lower.
Yeah, some of the tax cuts or the tax savings for taxpayers is all about the low income tax offset and the low and middle income tax offset, because that low and middle income tax offset was designed to be gone. It lasted 1 year, got extended for last year, and it was not meant to be available now, and it's been extended for another 12 months. And that's that $1,080 that most taxpayers are actually entitled to in their tax returns. So it's been extended. And then the normal low income tax offset has almost doubled from $445 up to $700. So that's going to provide some of that extra tax saving.
I guess the other measure that was announced in relation to the personal tax cuts was a CGT exemption for granny flats, which sort of caught my eye. Again, this is an interesting one. Did you want to run through how these rules are proposed?
One of those ones where I said this is targeted. It's actually not a free-for-all. It's actually planned to come in on the 1st of July 21, and it is still yet to be legislated. But it's a lot of people are now, and they actually say it's increased due to COVID, where people are looking at keeping their family members supposedly safer. And at the moment, to have a granny flat on your premises opens up capital gains tax for the granny flat, which is actually unintended, but is a consequence. But the restriction here is that it is actually, you've got to prove that it's for looking after the older or generation or somebody with a disability. So it is restricted. and that it needs to be only if you've actually got a formal written agreement for the granny flat arrangement. And they're saying some people are going into doing this, but they're building it, but they're not actually receiving any money until potentially, a parent dies to actually be able to effectively pay for it. So it is targeted. It's not for everybody. It's not retrospective, and it is still yet to be legislated. But it could help a lot of people.
So the scenario there would be if you do have a sort of a granny flat out the back and you've got uni students renting it out, then it's not going to be subject to these concessions. But if you've got elderly parents or potentially family members with a disability that are living in there, so they're closer to support, then arguably it's going to remain exempt from capital gains tax. Is the, I guess, the gist of the proposal. The next one, I think, is a really good measure, and it's often a question that we get asked when preparing individual tax returns. And this relates to tax deductions for retraining or reskilling. So at the moment, the way the legislation works, in order to claim a tax deduction for a training course, it needs to be in connection with your current employment. So if you're in the hospitality industry, and you're out of work at the moment and you go and retrain as a plumber, for example, then that cost of that training is not deductible because it's not connected to your current employment. But these proposals look to change the way that that's treated.
Yeah, from an individual tax return perspective, I think it's still being nutted out whether or not that actually extends that far to be able to claim essentially self-education for getting a job, getting a promotion, getting a new job. But the main thing there is that they actually have, from an employer's perspective, allowed an employer to fund the retraining and reskilling for somebody who was redundant or looking to potentially be redundant, where they can actually offer training and not be subject to fringe benefits tax. Because again, it was caught from an employer's perspective to retrain and upskill somebody that is not again linked to their current employment. So there is going to be some benefits there. It is, though there again are still restrictions around that. It can't be part of a salary package arrangement or part of a Commonwealth supported a training, but it can be provided by your employer, which could really set somebody up for a new role.
Yeah, and it's really that highlighting that focus on reskilling and skilling up the workforce. So as I said before, I like that incentive, as you mentioned. Whether that does actually extend into the personal tax space remains to be seen, but there's certainly that FBT exemption for businesses that provide it.
It's definitely lobbying for this to be extended into the personal tax return system. I don't think it's actually legislated yet.
Yep. Just moving on to some of the more the business side of things, and there were some additional announcements in relation to the small business tax concessions. And keep in mind, these are not to be confused with the small business CGT concessions, which are totally separate rules. But the small business tax concessions provide a range of simplified tax measures and concessions for small businesses. And basically what's happened there is there's been a change in the eligibility threshold.
Yeah, significant change there. Currently, a small business is, for these concessions is defined as business turnover less than $10 million. And that's being increased to $50 million. So it catches, which is effectively generally where the medium threshold starts. So a large amount of businesses now being included in that. And there's about 10 small business tax concessions. Again, not the capital gains tax. None of those thresholds have changed for the definitions there. But specifically with the small business tax concessions, there's about 10 that will open up to those businesses now up to $50 million in turnover. And that's aggregated turnover for a group. Some concessions are coming in as of the 1st of July 2020, so backdated, 1st of April 21, and then also some measures that are not coming into the 1st of July 21, but all within the next 12 months. The main significant ones are 1st of July 2020, just briefly, businesses who have startup expenses can have those 100% immediately tax deductible, and also come in where you can actually have prepaid expenditure, which most of our small businesses take up the opportunity to do so, as that's going to be now extended. 1st of April 21 will be some additional FBT, so fringe benefit tax exemptions, because that's the beginning of the new fringe benefit tax year. And 1st of July 21 will be some other small business tax concessions, including a trading stock concession, simpler BAS, so for GST, and then also reducing the amendment period from the current 4 years to a 2-year amendment period that current small businesses are able to obtain.
Yeah. So I guess in relation to that, probably the new concession in there. So there's two parts to this. One is these small business concessions are being made available to a larger number of taxpayers. But then there's also, for existing taxpayers, the new concessions, which is the FBT part. And that looks at making car parking FBT, car parking, fringe benefits on car parking provided by the employer exempt from FBT, as well as the use of multiple portable electronic devices. So under the current rules, each employee is allowed to receive one portable electronic device from their employer. It's not subject to fringe benefits tax. And now that's been changed to multiple devices.
Per annum, yeah.
So you would include a phone and a laptop, or a phone and a tablet. So yeah, there's certainly for our existing client base the ability there to one, immediately deduct the cost of those items and not be subject to FBT. The other big one that got announced and with a lot of fanfare was this instant asset write-off, which is something that's has been around for a little bit for a while, but has again been extended and had threshold amounts changed.
Yep. So up until the 12th of March, the instant asset write-off threshold was $30,000. 12th of March up to, it was the 31st of December this year, 2020, it was $150,000. So the first change is that date has been extended for a further 6 months to the 30th of June 21. So basically it's allowed businesses to, an extra 6 months to actually get their asset installed ready for use. So that is relevant then from the 12th of March up until really to the 6th of October. So as of 6th of October, that has now changed where it's effectively unlimited. You have to have a turnover less than 5 billion, which I think most people do. They say 99% of businesses now actually get that. There is still that 1% that won't. But now it's actually unlimited. Now it is on eligible, there's still some restrictions around cars because they are subject to depreciation limits and so forth, but generally other assets, so talking about huge machinery and all that kind of stuff. And the design is to get businesses spending soon, is that instant asset write-off for an unlimited amount, but it does have some restrictions. It is restricted to new depreciating assets or the cost of improving existing assets. And it does extend to secondhand assets, but only if your turnover is up to 50 million. So only what they're now increasing that sort of small to medium sized business. The bigger end of business still won't apply to secondhand goods for them. The business between 50 and 500 million can still have second-hand goods, but then it's restricted to the 150. That's still in play for the next 9 months. The other thing with that is that when you have, if you're a small business at the moment under 10 million, when you have this threshold of instant asset write-off, it also applies to your general pool balance. So up until the 6th of October, we thought that anybody with a general pool balance of under 150 would be able to write that off. And now that extends to their entire pool balance, doesn't matter how much it is. If you're a small business, your entire pool balance can get written off in the 21 financial year. So from a tax perspective, there's some huge tax deductions.
Yeah, and that's, I might bring Garry into the discussion here, because this is where these deductions aren't always what they seem. And particularly there's a couple of issues. One, where it can affect dividends that are paid. And then secondly, the upfront deduction is more just a timing difference over the life of the asset. The end result to the taxpayer is going to be exactly the same.
Yeah, that's right, Mark. And I think probably in regard to all the business tax concessions, it's really important for all businesses to individually assess their personal circumstances, because for one business that might acquire an asset, get an outright tax deduction, that might provide a benefit to them in the current year, but another business that has carried forward losses or has losses may not actually get a tax benefit in that year at all by acquiring an asset. So it's actually really important for businesses to make an assessment, because the government's been quite concessional, and it's all about this policy about a private enterprise-led recovery and creation of jobs. And there's a lot of incentives, but my experience probably has been is the businesses that get the most out of these incentives are those that clearly look at their own personal circumstances and look at the incentives that provide the biggest return for them. And that can vary with different circumstances, and what might be, most people would feel they would get some benefit out of buying an asset up front and getting a tax deduction, but for a fair significant part of a number of businesses, they may not. And the government have actually even indicated that in their budget estimates, where in regard to this particular measure itself, they indicated that the amount of expenditure they anticipated was about $2 billion worth of expenditure. And that would probably mean that, the average company tax rate of 30%, you'd expect a $6 billion cost to the budget, but the government's actually only about a $30 billion cost to the budget, which effectively is what they're saying is that they only anticipate that the flow and benefits out of an instant asset write-off will be about half to about 50% of the taxpayers. So there's a lot of ways that those tax benefits can leak out, as Mark mentioned. The ability to pay dividends, or and the ability to frank those dividends can be impacted by the instant asset write-off. So just important for everyone to make an assessment in regard to their business. And my experience has been with businesses that look at their personal circumstances, talk to their accountants, generally will get the best benefit out of all the incentives.
Yeah, and I guess you contrast these latest concessions with the instant asset write-off to the measures back in the GFC, which I think was at the time the Rudd government brought in. With this, they had this concept of an investment allowance. So if you bought a new piece of equipment that cost $100,000, you got $100,000 upfront tax deduction, and then you effectively got to depreciate the asset as you normally would. And that did provide an enduring tax saving to the taxpayer, because they effectively got a double deduction. Whereas these measures, it's just a timing difference. You're getting a deduction for your $100,000 in the current financial year, but you're missing out on deductions that you would have otherwise got over the following financial years. So it's definitely, is it going to get people spending money? Probably if they need the asset, it's going to make it the decision to buy easier. But the one thing that we've always said, particularly when it comes to buying assets or or purchasing everything with a tax benefit in mind, in a company scenario, you're spending $100 to save $30 ordinarily. So, for every dollar that you spend, you might get a tax concession, but you're still out of pocket. So, my thoughts there are still consider as to whether or not you need the asset. Because if you don't really need the asset, but you're buying it because you're going to get an upfront tax deduction, you'd need to question the merit in doing that. The other... Sorry.
Is the government's clearly just taking a spend money to make money approach. And with all of these things, by giving the instant asset write-off, by putting money or reducing tax rate, by putting money back into the hands of businesses and individuals, really they're banking on creating, the trickle-down effect, people spending more money, creating profits for businesses, creating wealth generation into the future, where, like you said, these tax deductions will be a temporary difference, but at some future point, there'll be a greater amount of profit or wealth that everybody will be paying tax on to help pay back the measures that they're spending on right now.
Yeah. So the flow on, or as I mentioned earlier, the temporary loss carryback, again, was a measure that we've seen before, that's reintroduced. But again, all is not what it seems in relation to this one as well.
So yeah, this was came in for the 12-13 financial year. Didn't last very long at all. Had too many hindrances really at the time. But generally what you need to do when you make a loss, you then generally have to wait till you trade profitably in the future to then offset your loss. And right now what they're trying to do is saying businesses need money now, and they're allowing you to look back, and if you make losses in the 20, 21 or 22 financial years, you can basically look at the tax that you paid in a profitable year in either the the 2019 or later financial year, and get a refundable tax offset for that. And then effectively you've used some of those losses backwards, and then you can potentially carry forward a smaller amount, if any, for future use. So you're not losing any of the losses. It's just saying, rather than waiting to have to trade profitably to get some tax benefit, they'll enable you to look back. The issue really is that there are restrictions around, one, it's only for incorporated entities, so generally companies. So sole traders, partnerships, trusts are ineligible. And the one main restriction is that it can't generate a franking account deficit. So you can't, you can only do it if you actually have a suitable franking account balance, which potentially makes some companies ineligible to be able to do it. It's restricted to actually the amount of profits that you made in the earlier years. But it will be a refundable tax offset in either the 21 or the 22 income tax returns. So you don't actually have to make any decisions. It's not compulsory. It's an opt-in thing. So it's actually really looking at your circumstances at the time you're doing those two tax returns to see whether or not it's actually applicable to you, and then whether or not you want to take it up. So it's nothing that you have to do in advance to actually work out your eligibility or anything like that. But as part of your 21 and 22 tax returns, you do need to look at this as an option and know that it is just an option.
So it will be relevant, firstly, for those businesses that are trading as a company, first and foremost. But then again, it's important to dive in to look at what impact it might have if we go back and claim those losses.
And it's not at 12 months in the future too. It's not an immediate tax saving, because you actually have to do your 21 tax return, which can't be done for 9 months.
Yeah. The next one here, the FPT concessions, we've pretty much already covered earlier on, which is in relation to the broader exemption for retraining and reskilling activities. So we probably won't touch too much more on that. There were some other measures that are not necessarily tax related mentioned in the budget, but more around streamlining the way that businesses interact with each other and the regulatory authorities. And we'll just run through these really quickly. The first one is insolvency reform. And really what that's doing is it's making it easier for businesses, particularly those businesses with less than a turnover of $1 million, to keep trading while they're reorganising their affairs, but then also provide a simplified liquidation pathway for small businesses. And as we know, liquidation can be, it can be a costly exercise. So I think, reforms in this area, particularly for smaller clients, are welcome. Interestingly, there's, and this will be interesting in next week's presentation with Ryan Bradbury, to talk about this a little bit more, but interestingly, there's additional support for the insolvency sector so that they can respond to the short-term and long-term increase in demand for clients needing assistance in this space. What we're seeing right at the moment is there's virtually zero demand for that, but clearly Treasury is expecting an increase in demand in this area and are looking at funding it. So we'll probably touch more on that potentially a little bit in next week's webinar. The second one, whoops, I went the wrong way. The second one is an interesting one, and this is the concept of a director identity number. Think of it as a tax file number concept that identifies directors. And this is in relation to helping manage the phoenixing. So phoenixing is where a company shuts down with debts and opens up the next day and starts again with the same directors. There's actually no way of specifically identifying directors other than by their names. And as you know, there could be directors with the same names. So this thing will be that each director will now have a director identity number. As I said, think of it similar to a tax file number. And they'll be required to report that number back to ASIC for each company that they're a director of. So ASIC will be able to easily compile a list of companies that can be attached to specific directors. So, the phoenixing cost to the economy is estimated between $2.9 and $5.1 billion a year. So it's, there's a significant leakage of revenue there. And this director identity number is one way of, streamlining the processing and giving the authorities better access to information. And the third one that I just sort of wanted to briefly talk about is the concept of a Commonwealth Business Registry. At the moment, there are about 35 different business registries across the country. So we know we've got one for our ACN regime, looks at, or ASIC looks at companies. We've got the ABR, which manages ABN. We've got, business name. We've got a whole lot of different registers, and the government has spent some money there in looking at introducing the Modernising Business Registers program, which is basically designed to incorporate all of that into a single platform. Again, making it easier for businesses to deal with the regulatory authorities and cutting sort of red tape there. So that's expected to be operating from 2021. So no real tax benefits in these measures, but some common sense approaches to making life a little bit easier and using technology to facilitate that. All right, we'll move quickly along to superannuation now. And again, in relation to superannuation measures, there were no real announcements in relation to changes in the way that superannuation is taxed or the way that superannuation operates through the regulatory framework. But there are a number of concepts that they're looking at introducing, and the first one is their Your Super, My Super program. And basically what that's looking to do is bringing in a standard superannuation comparison tool to help employees choose a super fund. And in addition to that, those default super funds, or those standard super funds, will be accountable to certain standards, and I'll get to that in a second. In relation to the Your Super, My Super changes is this concept of stapled super, and this is going to be a real benefit to employers. So at the moment, if an employee doesn't nominate a super fund that they want their employer to pay into, the employer must provide a default fund and make the payments into that fund. The concept now is that each employee will now select their own default fund effectively, and that'll be registered through a superannuation portal at the tax office that employers will have access to. So if I'm starting out and I nominate XYZ super fund, that super fund becomes attached to me. So when I change employers, if I don't specifically nominate a super fund, my employer just looks up the registry, finds my name, finds the super fund that's attached to me, and makes the contributions into that fund. And what that's designed to do is to stop employees having multiple different superannuation accounts, which, as we know from a fees perspective, can become quite costly. In relation to those choices of funds that employees can choose from, they're subject to certain performance requirements. So if those funds aren't performing in line with the way that the market's performing, they actually can't accept new members until they fall back into alignment with the benchmarks. So if one of those funds that's available through the Your Super, My Super system is returning 2% when the benchmark is 8%, well, they actually can't accept new members into that fund until they improve their performance. So some more practical changes there in relation to superannuation, and making it easier for employers to pay super for their employees. Just probably now is more as a heads up, and we may see more of this in the next budget, which we're expecting to hand down, which we're expected to be handed down in May of next year, is in relation to superannuation guarantee. So for those of you that aren't aware, the current superannuation guarantee amount of 9.5% is legislated to increase to 10% from July 2021. So there was a school of thought that given the current environment, but that increase in super may be put on hold and delayed for a further period of time. There was certainly no announced changes in this budget in relation to doing that. There is a school of thought out there that may suggest that they might defer it again in the next budget, but there's the jury's still out on that one a little bit. And I guess I'd be interested in your comments, either of you, as to what impact you see that change in the super guarantee rate going from 9.5% to 10% might have on businesses.
My gut feel is that most businesses will have no problems in sort of increase it. If you look at in businesses, they look at increasing their superannuation by a 20th, which effectively represents that it's not going to really be a significant cost burden to any business, particularly most small businesses.
Yeah, and that will result in a real increase in wages going forward.
Yeah, and I think you'll probably find that most employers will give that consideration with any wage increases they pass on during that period of time.
Yep. So stay tuned for that one. I'm expecting we may hear more about that in the next budget. Finally, just in relation to super, some of the COVID-19 measures that were previously announced, and more just a refresher, the temporary early access to superannuation scheme is still running and runs up until the 31st of December. So that gives you the opportunity to access up to $10,000 worth of your superannuation if you can show that you've had a reduction in hours worked. So just to let people know that that is still available. And then secondly, for those clients that are drawing pensions, or those retirees that are drawing pensions down from their super funds, as you know, there's a minimum amount that you're required to draw down each year. For the 2020 financial year, that amount has been halved, and that remains in place for the 2021 financial year as well. So there's a 50% reduction on the minimum drawdown in relation to accessing pensions from superannuation. So we'll move on from super now and shift our focus to research and development, or R&D, and there's been a few announcements in this space. So I'll bring you in here, Garry, just to provide a little bit of an overview. There's changes for companies with turnovers of less than 20 million, changes for companies with turnovers of more than 20 million, and then some changes that will apply to all companies.
Yeah, thanks, Mark. So research and development has always been used as a means of creating incentive for R&D activities in all businesses and the startup industry. As in the 2018 budget, there was an announcement that they were going to reduce the expenditure in the R&D program by about $1.8 billion. That was, a lot of those measures were meant to be brought in place on the 1st of July this year. They've been held up through Parliament passing legislation, and there was concern about we've already started lodging R&D tax returns and the feeling we might need to amend them. As a consequence, this budget, the R&D program's now been increased by $2 billion, which totally goes to offset the 1.8 it was going to reduce by. Now, that's been implemented by a range of measures, both in regard to companies with a turnover less than 20 million, which is the vast majority of the clients that we have R&D claims for, and then there's some measures that apply to businesses with turnover over $20 million. The key measure, I suppose, for the smaller businesses is that the R&D incentive has gone from 13.5 to 18.5 above the company tax rate that's applicable. So that's effectively going to increase the amount of R&D claimable for those companies. There's also been some technical changes, or rather than changes, some of the technical changes that were proposed in the 2018 budget, which were meant to come on the 1st of July this year. There's been a retraction away from those changes, which effectively means that the R&D incentive will be higher as a consequence of those changes. In regard to some of the larger company changes, so firstly, that there was going to be a cap on the R&D refunds of up to $4 million. That's now been removed. In regard to the larger companies, that there's been an intensity of R&D activity measure that was being put in place a couple of years ago. That's now been improved and relaxed to the extent now that the R&D expenditure, or the uplift factor that above the company tax rate for companies that have R&D expenditure less than 2% of their total expenditure, it will be 8.5%. With those that have R&D expenditure more than 2% of their total expenditure, that will now increase to 16.5%. So their measures are all designed around improving or increasing the amount of R&D activity, and very much closely connected with the government's overall strategy about a private sector-led recovery of the economy and also job creation. And I suppose a lot of these measures are relating to not only job creation, but job retention. So the best way to increase the number of jobs in the economy is to make sure you don't actually lose as many jobs out of the economy too. So I think that's to be kept in mind, that the measures are designed to be incentives around people retaining jobs and companies maintaining jobs, and then secondly, to create incentives to create jobs going forward. And I suppose that goes on to some of the other measures in regard to the JobMaker plan. A lot of people would probably, smaller businesses, sometimes probably feel that some of these measures are excluded for them, but I explain where a lot of small businesses, certainly a number of our clients, need to consider that some of these measures might apply to them. The first thing is that the part of the modern manufacturing strategy is applied to 6 precise industries, including the resources, technology and critical minerals processing, food and beverages, medical products, recycling and clean energy, and defence and space. Now, I know that I'd say that more than half our small business clients would probably feel that none of this applies to them. But in fact, the measures you need to really consider how the measures might apply to a lot of businesses. And where they might apply is that, and where the modern manufacturing strategy is designed to have broader application, is that the strategy is about how you might partner with people who are in those industries. So it could well be you have a customer or a supplier who's based in those industries that you currently do work with. Well, it may be that as a consortium, you may form part of a consortium that undertakes work that's entitled to some of the benefits that are under the strategy, which is a basic grant-based program. So it's important to probably consider whether you can talk to some of your customers, suppliers, work out where there's new innovation that you might be able to consider taking on, what funding might be available for the innovation, and then look at forming some sort of joint venture or partnership. So certainly if you're in one of those industries, the incentives are based around actively encouraging you to form consortiums with either through your supply chains, through your customers, or potentially through universities who receive particular funding under different grant programs. So just what I'd say to people, have an open mind to some of these incentives, because it might be initially that there's a feeling it doesn't apply to you, but give consideration to how a broader perspective about whether you've got customers or suppliers in those industries and how they might apply. And that's really what the modern manufacturing strategy in the budget's designed. We'll get further details about it as that's released. And certainly, our contacts through Oz Industry will probably be the channel organisation that's facilitating a lot of these measures.
Yeah, and I guess that one of the key focuses of the budget is this JobMaker scheme, and the modern manufacturing strategy is part of that. Probably the key part of those JobMaker reforms, or the JobMaker scheme, is this JobMaker hiring credit, which is something that is totally new. So I'd like to bring Nick in here to just discuss how that may work for businesses.
Yeah, thanks, Mark. I guess there's a couple of parts here designed around one, getting people previously not in employment into jobs, and two, providing the incentive for employers to make investment decisions, which is, I guess, something quite critical. And with both the JobMaker hiring credit and the apprenticeship wage subsidy, which I'll touch on shortly, it provides a real incentive to businesses to be able to take that leap to invest in new employees, to be able to try and grow their businesses. And I guess, like everything, and lots of clients would have heard me talk about the cash flow impact of growth at various points in time. But you effectively need to invest in your business, whether it's in stock, in staff, in order to create the capacity, in order to go and do additional work, to be able to build that extra work and then collect the cash. So I see it as quite a significant thing to incentivize businesses to be able to grow and create, I guess, that economic growth the government's after. with the JobMaker hiring credit, it's available to employers from the 7th of October, just gone, for a 12-month window. And it's for eligible new employees where you can demonstrate an increase in overall headcount. And for employees that are 16 to 29 years old, it'll be a credit of $200 per week to the employer, or over the course of a year, $10,400. And for employees that are from 30 to 35 years old, it's $100 a week. Unfortunately, for employees who are over 35, there is actually no hiring credit available. And I guess the other important part to note around the hiring credit is that eligible employees need to work a minimum of 20 hours per week averaged over a quarter for you. And they need to have previously received either JobSeeker, youth allowance, or parenting payment for at least 1 month out of the 3 months prior to being employed. So it's not just for any new employees. It needs to be for those who previously received one of those government benefits that are getting into a new job where it's increasing your overall headcount. So again, encouraging businesses to invest, but invest in people who previously haven't had employment as well.
I think there's been a little bit of commentary around that, Nick, is that not only are businesses going to have to demonstrate an increase in headcount, but it also demonstrate an increase in payroll in dollar terms. And what that's designed to do is to replace one full-time person with 2 part-time people, therefore get the increase in headcount, but not necessarily an increase in actual payroll. So, as I said, the rules, the legislation hasn't come out around that, but there are some sort of measures there to stop those things from happening. I guess the other thing is there that the businesses can't be getting JobKeeper and JobMaker hiring credit at the same time.
Yeah, absolutely. And look, that's very similar again to the apprentice rebate that was brought in just before JobKeeper was announced, that you could claim one or the other. And it's fairly typical to make sure businesses aren't double dipping.
Yeah. And some of the commentary I've also read, Nick, is that it does apply to new businesses for the employees after the first employee.
Yeah, it does. And I think that's an important point to note as well, Mark, that businesses starting for the first time don't qualify for their first employee. So it's actually from the second employee onwards. But again, depending on your structure, if you're in a company or a trust, the owner may be the first employee. Important to note, they don't qualify themselves, but once they then go and invest in putting on somebody else, that's when they can qualify. As I said, this program is available for new businesses until the 6th of October next year, 2021.
Yeah. So look, it just gives businesses something else to think about when they're choosing who they might want to appoint. And certainly a significant subsidy to the wages in the first year for that person.
Definitely.
We just wanted to quickly cover off on the JobKeeper payment extension. Not necessarily a budget announcement, but announcements prior to the budget there.
Yeah, look, just a refresher for everybody there, that JobKeeper has been extended from 28th of September until the end of March next year. It'll be in 2 tranches, so we need to qualify for effectively October to December quarter, and then qualify again for the January to March quarter. And there are some, I guess, different eligibility criteria to the first round of JobKeeper, which we're working through with all our clients at the moment. And if anybody thinks that they may be eligible, is to just touch base with us. And probably the other key change is really that there's now 2 tiers for employee payment rates based on the number of hours that employees were working during, I guess, one of 2 reference periods earlier in the year.
Yeah, I guess what we're finding in the office is more people are getting into JobKeeper 2.0 than what we had initially anticipated. So yeah, it was a little bit. We weren't anticipating as many people to get in that are actually getting in. So
yeah, one of the things I've noticed across my client base there is that part of the clients who are probably gets an increase in clients able to get into JobKeeper 2 is off the back of a lot of clients having a really strong September quarter last year, which has meant that satisfying that 30% drop in revenue, even though it is on a cash, well, for a lot of clients on a cash basis or their BAS method, it has become a little bit easier than we anticipated. And look, when I say easier, we're probably expecting 1 or 2 out of 10 clients to qualify, and it's probably marginally higher.
yep. You touched earlier on the apprenticeship wage subsidy.
Yes, so this is, I guess, very similar to the apprentice rebate that was announced back in March, but there's effectively a 50% rebate or subsidy to employers up to $7,000 per quarter, or a maximum of 50% of the apprentice's wage. And I think that is for the first 12 months. Might want to correct me if that does go for longer, but effectively it means that $7,000 per quarter per apprentice, up to a maximum of 50% of the apprentice's wage. So if they're earning $14,000 per quarter or $56,000 per year, then you'd be eligible for a full rebate of half that back. If not, maybe something slightly less. Again, yeah, for me, I think really what this means in the practical sense is that for a lot of businesses, need to reconsider their recruitment strategies. And I've been a big advocate of apprentices and trainees for a long time based on the value or the bang for buck that they bring to businesses, where in my mind, there is no doubt that if you're willing to put in the hard yards from a training perspective, the value you get back far outweighs that. And for certain businesses, just reevaluating whether they go back to looking at or employing at an apprentice or a trainee level, as opposed to a partly qualified level, is something that needs strong consideration.
Yeah, and just to finish off, again, more by way of information, that the JobSeeker payment has been increased by $250 per fortnight through to the end of December on the base rate. So whilst ever JobKeeper seems to be around, there's been additional payments to those on JobSeeker above the normal legislated rate. So we just wanted to include that. For
just a question through Mark, sorry, on the apprenticeship wage subsidy, about whether it applies to trainees. It does apply to traineeships, but just like apprenticeships, they need to be a registered traineeship through a training provider. It's not just as simple as calling somebody a trainee, as I was called when I first started my accounting career. There was nothing formal about that traineeship. So if it is a registered traineeship, then it can qualify similar to apprenticeships.
Yep. Thanks for that question. All right. So that's probably brought us to the end of the sort of measures announced in the budget. There's a reasonable amount to go through. And as I said earlier on, it will impact different clients and different businesses in different ways. So hopefully there's a little bit in there for everybody, but it really then becomes a matter of sitting down and working out how best to take advantage of the measures, as Garry pointed out. Just on next week's presentation, Nick is going to be joined by Ryan Bradbury, who's a liquidator with Nichols and Bryan, and they're going to be talking about how insolvency laws are changing, and really about what businesses that find themselves under some financial difficulty or some financial stress, what options they've got to get through that period. So we've done a lot of work with Ryan in the past, and when people think about liquidation, there's certainly negative connotations that come about, but what we've seen is really great outcomes for clients that go through that process. So Nick and Ryan will be looking at that next week. So we might wind it up there. Thank you for everyone for attending. Thanks to Garry, Angela and Nick for sharing your thoughts, and we look forward to seeing everyone next week. Thank you.